Well, firstly, it's unusual to have two Fed presidents or two current Fed presidents presenting at the same conference, combined with former Fed Governor Janet Yellen. And our interpretation was that they were there to give a message. And the message was that the Fed does not see a recession on the horizon. The US economy is in good shape. GDP growth of 1.75%, that's about trend. Unemployment is very low at 3.8%, and inflation is well controlled at 2%. They also spend a lot of time talking about yield inversion. So yield inversion is where the yield on longer term bonds or longer term treasuries is lower than the yield on shorter term treasuries. What that indicates is the bond market believes that due to a slowdown in activity, interest rate cuts will be required in the future, and so they're factoring that into the longer term rates. In the past, that's been a very good indicator of imminent recession. The Fed governors spent a lot of time discussing why they don't believe the inverted curve is a good indicator of imminent recession, and there's a few reasons they gave. Firstly, they believe that the curve or the flatter curve is structural. So various reasons for that: ageing, demographics, as the developed market population is getting older, there is more demand for capital stability and income, and that encourages the holding of bonds. Secondly, as I mentioned earlier, why they believe the yield curve flatness is structural is that inflation is well controlled, and that should continue on. And then finally, they talked about quantitative easing, and we've seen that quantitative easing pushes yields down right across the curve, and quantitative easing is well and truly on the table, and that's impacting markets. So what that means, we've got one of those interesting points in history, and perhaps unusually, we've got a situation where what the Fed was saying is positive for both bonds and equities. Less so for bonds. So bond yields are low compared to history, but what the Fed was saying is that if they have to, they'll put downward pressure on yields, and that's good for bond valuations. But also it's good for equities. So keeping interest rates down, yields down, that encourages borrowing, that encourages activity. That's good for corporates. Also, lower bond yields means the valuation of equities is higher. The discount rate of the cash flows being produced by corporates is higher. So it's positive for equities. So in conclusion, what we've been saying to our clients is have a full allocation to bonds, particularly Aussie government bonds, federal bonds, and be overweight equities. And the overweight in equities we're expressing through the US, particularly as we're bullish the tech sector, technology, and the US is the home of technology, and also through an overweight in emerging market equities, and particularly with an emphasis on China, which is undertaking a stimulus program.